Good morning. Welcome to the Next Level Mortgaging Podcast. I'm your host, Todd Martin from Mission 35 Mortgages. And this week thought I would talk a little bit about the difference between switches, renewals, and refinances, since that is a big part of the business right now because of the way the market is. There's a lot of people that are leery to buy, a lot of people that are leery to sell, so they are staying put and just re-upping where they are. So what are the differences? What are the concerns? How do you navigate what you're working with, and how can you maximize what you're working with at the time? So the simplest one is a renewal. Renewals are, you have mortgage coming up, it's due June 12th. The bank sends you a statement or sends you a quote, says this is what we're willing to renew you for. You sign off on it, or you negotiate, you negotiate for a better rate, whatever, and away you go. Now, there are some new rules for all three except for refinance. So for renewals and switches, there are a couple of new rules that started this year. So you no longer have to stress test for renewals and switches, which means that you no longer have to qualify at 2% higher as long as you are not adding any money to your mortgage. So that means renewals and switches. As long as your mortgage is staying the same, the amount is staying the same, whatever your new rate is, that is what you qualify for. So that makes things just a little bit easier this year. Something the government came out with to help people take a little bit of the pain of the last 18 months out and staying out of it for the upcoming, 24 months or so. It will make things a little bit easier. You do not have to do that stress test. And some of the times when you're renewing, the bank will simply, they won't even, make you requalify. They'll simply make you the offer. You sign off on it and you move on. Switching is when you want to try to find a slightly better rate. You want to find, you're not happy with your bank. There's something else you want to look for, in the way of you want different options on your mortgage. You want portability. You want the ability to get out of it sooner. Maybe you want a 1 or 2 year and your bank doesn't offer that. So you want to switch. And that means going from one bank to another. Now, oftentimes there are fees. There are always fees when you do a switch. So you're looking at, an assignment fee, a detachment fee from your existing mortgage, and legal fees. Oftentimes it's going to cost you between $2,000 and $3,000. Some banks will absorb this fee because they're always looking for new business. So accepting $2,000 to $3,000 fee to take on the interest of a new mortgage is more than worth it to them to absorb those fees. Excuse me. So what happens then? Then you have to reapply. Then you have to requalify. But you still do, as long as you are not putting any more money on, which you're not if you're just switching. Again, you do not have to stress test. You just qualify at the rate. So if you are qualifying at 4.89%, 4.89% is what you stay at. You do not go up to 6.89%. And so that makes things just a little bit easier in this market. A refinance is when you want to add a little bit more money, or there's something else you want to do to your mortgage. So say you want to add some money to it to do some remodel, you want to pay off some debt, whatever you want to do. You want to pay off a car, you want to take out some money to buy a car, anything along those lines, because mortgage rates are lower than most loans, definitely lower than all credit card payments out there. They're lower than, it's a good way to take out some money to renovate, and say you want to renovate and sell, anything along those lines. So that means you're adding value to the mortgage. You're adding value to the mortgage. So that is a refinance. That means you're going to stress test. That means because now you're getting a totally new mortgage. You're adding on to it. You're adding value to it. You're going from $400,000 to $500,000. You're going from $300,000 to $325,000, whatever it happens to be. So that's a totally new mortgage. You're going for a new product. You can shop around. We can look at different places, different products. whatever it may be. And so there's going to be refinance fee, there's going to be legal fees, and all that kind of stuff. But we will break that all down for you. We'll show you all the fees, all the costs, all the expenses, closing costs, all that. And then you make the decision whether it's worthwhile for you at that point to refinance or simply go back to a switch or a renew. Refinances can happen at any point in time, whereas renewals and switches tend to be at renewal times. Refinances can happen at any point in time. If you're going to renew in the middle of your mortgage, you will have to pay a penalty on your existing mortgage. So what are the penalties? So there's a lot of people that have a lot of confusion when it comes to the penalties. So there are two basic penalties when it comes to a mortgage. There is a 3-month interest penalty. This is the simplest one. You pay 3 months of your existing, whatever your existing rate is, on whatever amount you have left on your mortgage. So if you have $500,000 left on your mortgage and your interest rate is at 4%, you pay 3 months, you take 4% divided by 12, multiply it times 500,000, multiply it times 3. That's your 3 months interest rate. Now, the other way, and that will happen most of the time on variable rate mortgages, almost all variable rate mortgages will have this penalty. Fixed rate mortgages have this penalty, or they will have the option to be an interest rate differential penalty, which means if your interest rate drops, if you have a lower interest rate than what your current interest rate is, so if you're going into a new mortgage with a lower rate than what your current mortgage rate is, they will take whatever that difference in the interest rate is and then multiply it times your current amount on your mortgage and however many months you have left. So if you're going from 4% to 3%, they're going to take 1%, multiply it times your $500,000 times, say you have 2 years left, times 24%, or times 24 months. And then whatever is higher. So if that is higher or the 3 months interest is higher, that's what you're going to get penalized. So that's how breaking your mortgage, that's how the penalized works. And so that's the refinance. That's how the refinance works. So those are the differences between a renewal, a switch, and refinance. A renewal is simply taking your mortgage, re-upping with where you are. A switch is taking your mortgage and keeping everything the same, just moving it to a different bank. Refinance is you're adding to it, you're changing your mortgage, and somehow you're adding money to it, something like, and then it's a brand new mortgage. So I hope this helps, guys. If you have any questions, don't forget to look me up. Don't forget to hit that like button, subscribe button. If you have any questions, you know where I am. Enjoy your week. Go, 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 go.